In today's Property Insider Chat, Dr. Andrew Wilson and I discuss a lot of the news that's happened over the last week and how that may affect our housing markets, interest rates and inflation. We talk a little bit about the Labor and Coalition election promises and how that's only going to lead to more demand and push up property values. We discuss the latest housing approval figures, what's likely to be happening to inflation with some recent data that's come out, the auction clearance results, and lots more to give you an indication of how our housing markets are likely to perform moving forward. If you're keen to keep up to date with what's happening in property, please subscribe to this YouTube channel and click the little bell icon so we can let you know each time a new show comes out. Australia's housing crisis has become a fierce political battle that could have major implications on the outcome of the federal election. The problem is there's no quick fixes to the housing crisis, yet both the Coalition and Labor continue to chase short-term solutions that don't address the real issues. Anything easy and popular won't work to solve the housing affordability or the shortage of houses. Fact is, we're just not building enough new dwellings. And in today's Property Insider Chat, I want to ask Dr. Andrew Wilson's thoughts about the latest housing building approvals, as well as get his opinion on the latest inflation data, plus what's happening in the world of economics and politics. Hi, Andrew.
Yeah, g'day, Michael. It's interesting, as we were chatting before, the policymakers continue to focus on the demand side of the imbalance we have between supply and demand, and continue to announce new policies, trying to get more people into the housing market. The problem is we don't have any houses to offer them. So regardless of the handouts, it's just like a dog chasing its tail, because higher prices have to follow a lack of supply. And if they want my opinion, and can I give my opinion on a policy, Michael?
Yes, please. Why not?
Why not? So we've been saying here for a long time, as we've been doing this show, that the problem does lie on the supply side. And that's why we regularly show the ABS building approval data, and we'll look at the latest data today. But that's where the problem lies, on the supply side. But if you did want to fix the supply side, the biggest problem is planning control. And that focuses around the fact that the Constitution tells us that the control for land planning is the jurisdiction of state and local governments. So here's an idea. Why don't the parties get together and all agree to have a referendum to change the Constitution that allows the national government to be responsible for land planning? And then we could have policies that were free from the unfortunate constraints that happen, particularly political constraints at the local level in regard to land planning. Now, this wouldn't be popular, Michael. We know that, and we've discussed why. And the only way a referendum would get up was if all the political parties agreed to it. So I can just sort of say that this is a speculative policy which will never, ever happen.
Part of it has, Andrew, because we can see state governments are now taking more control over the local councils, aren't they?
Well, they are, but the point is we can't get a national solution to this.
No.
And there'll always be outliers in terms of those relationships between states and local government authorities. And you're 100% right. States have made a move, and we will see some of the results today, particularly with unit development, has started to pick up strongly. But the problem is that house development is now falling away. So it's, we get a feast or a famine in one sector. But as I said, I was a bit tongue-in-cheek with my suggestion, but I'm just sort of emphasising that it's a real systemic problem that we have in terms of supply. And we're really, to some degree, nibbling at the edges, and it's certainly looking better. But we've got such a long way to go. But I'm not sure that creating more demand, it might be a nice feel-good policy during an election campaign, is going to produce more accessible housing market, which we clearly need. Because again, it's the old story. If you throw money at people, giving them handouts, it usually in a supply shortage or a supply short environment, it only puts prices up.
It kicks the issue of affordability down the road. Now, the Coalition have proposed to allow first home buyers to have a tax deduction for the first 5 years if they buy a new property. So that's good that it's going to encourage them to buy new properties, but no one's building them at the moment. And we already have an underlying shortage to start off with.
Again, it only puts upward pressure on prices because you're bringing more people into the market who normally wouldn't be there in the market, which will create more demand with the same level of supply. And particularly given, even though we're seeing better numbers from the apartment side of the equation, we're seeing actually now a decline in house building approvals. And with apartments, of course, those approvals, which have been rising recently, are going to take some years before they actually become completed dwellings that are available for people to live in. So, it's an election campaign, and we should expect these types of sort of knee-jerk reactions and short-termism in terms of the trying to offset the, our imbalance between supply and demand. When, as we've said here, ad nauseum for years, the problem is we need to build more homes, not get more buyers into the market.
Well, the housing market regularly reports home building approvals, and we know we always give the disclaimer that just because an approval has come out doesn't mean it's built, particularly in apartments. But what do the latest figures show, Andrew?
Yeah, well, we look at building approvals, Michael, because they are the first indication of new supply in the marketplace. If we waited for completions, that would be sometime down the track, and it would be backward looking. There's not a big difference between the number of approvals in terms of the series. In other words, the proportion of completions to approvals usually is around about the same going forward, maybe 90% approvals turning to completions. But so they do provide us with a handy measure of the supply line for housing. Latest data was for February, down marginally, so it was a steady result. We've certainly seen a pickup from the up and down volatility of building approvals over the last couple of years, which we see because we can get a bigger approval for apartments 1 month, which and then it's not followed up the next month, so you get highs and lows. But we've seen a bit more consistency in terms of building approval numbers in total have been either flat or higher over recent months. So there's been hasn't been as much of that volatility in the market. But nonetheless, home building approvals totally were down by 0.1% over February. There's private sector, national home building approvals. And that followed a big rise in January of 5.9%, which was, as I was explaining, driven by a surge in apartment approvals over January. Units were actually down over February, 1.5%. Houses up marginally by 1%, sort of a flat month, February, Michael. Victoria was on top, which it normally is, although it battles with New South Wales for the top approvers of new housing, up by 36.4%. But that was on the back, again, saying of a big surge in apartment approvals over February. But our growth levels still remain relatively depressed, but the quarterly trend certainly is rising. And when we look at the actual data, total dwellings up, as I mentioned, down 0.1%, units down 1.5%, houses up 1%. So a flat result over February. But we can see the year to date. And of course, the year to date means January and February versus January and February last year. We're seeing, a real surge in apartment approvals, Michael, up by 55.8%. Wow. And house approvals up by 6.9%. Over the full year, a house is up 8.7%. So that's the year ending February and that's the full year ending February versus the full year ending February 2024, the previous year, up by 6.9%. Units and total dwellings up 8%. So we're moving in the right direction, Michael. But the point is we're still well behind where we were, in terms of our longer term trends. Total building approvals, private sector building approvals, well ahead of where they were a year ago, courtesy mainly of apartment buildings. So that trend is starting to rise, Michael. But I think that we were looking at around about 220,000 new homes approved a year. That was the target, or the aspirational target, set up by the government a year or two ago, if I remember correctly. So we're now at 16,000 on a monthly basis. So that's bringing us still, and that's with a rise over the last 12 months, but we're still under 200,000 if we multiply that by 12, Michael, for the year. And so we're still not, given growth over the last 12 months, particularly last 6 months, anywhere near the target that we need. And let's remember that target was for completed properties and not for approvals, which we won't get the same number coming through as completions as we have approvals. And the HIA were also predicting the same sort of numbers. So whatever the good intentions are and whatever the money that's thrown at infrastructure development by the federal government, it really hasn't made much difference to getting anywhere near that target, that long-term target that the federal government had proposed. And what we're doing here is just creating new demand with these latest policies. And when we look at the breakdown houses and units, we can see it's units. The trend for units has certainly risen sharply, and unit approvals are well ahead of where they were over February last year. And house approvals just up slightly over where they were last year. But house building approvals for houses has really flattened over the trend has really flattened over the last 6 months, Michael, which isn't a good sign for those looking for detached housing. But certainly the pickup has been with apartment development. And that's what you mentioned. We are starting to get a lot more activity from state governments in terms of fast tracking building approvals for higher density development, particularly in more established areas. So apartments are doing all the heavier lifting at the moment in terms of approval, Michael, but houses have started to move backwards. When we look at the state breakdowns, as usual, Melbourne leads the charge in terms of overall approvals this year so far. Melbourne is also leading in overall approvals for units as well as houses, which it typically leads. Some of the smaller capital cities are still doing pretty well this year so far, with Perth sitting there in third place in terms of total home building approvals this year so far, over 3,000, which is well ahead of Brisbane, and also well ahead of Brisbane for both houses and units. So supply levels are certainly accelerating in Perth particularly, and over the year to date we can see Melbourne's been the big mover in terms of apartment approvals of the substantial markets, up by 107%. The number of unit approvals over the year to date, that's the first 2 months compared to the same period last month. Adelaide's up by 190%. But that is a smaller market, and that's coming off a small base. All the capitals are reporting very strong growth this year so far in approvals for apartments compared to the same period last year, and that's what we're seeing with the national trends, of course, Michael. And when we do look at the capital city building approval trends, on the rise now, but well behind, still 31% lower than the peak trend approvals in 2016. And again, we can see a flattening when we break that long-term trend down for capital city building approvals, that houses are starting to taper off, but we're seeing a rise in units, a significant rise in units, the trend for unit building approvals, but it's still down 31.5% since that 2016 peak. So we've got a long way to go before we catch up to where we were, Michael. So unfortunately, that means continuing higher prices and rents.
Well, inflation was in the news, in the headlines continuously last year. And over the last couple of months, it's been pushed out by elections and more recently by Trump's tariffs. But that's also going to be interesting how that's going to affect inflation and our interest rates. I've read various commentators suggesting it's going to lower inflation and others saying it's going to raise it. But we did get some figures recently about the February headline inflation figures. What happened there?
Well, there's some good news for those that are looking for perhaps lower interest rates, Michael. That's why we look at these figures in some depth today, because of course, the Reserve Bank looks at the quarterly data set. The next quarterly data set will be out towards the end of April. That'll be the March quarter data set, which will be just in time for the RBA's meeting in May. So what we do is we look at the monthly data, because it gives us a bit of a lead into what will happen with the quarterly data set. And we break it down into the key components, so they give us a sense of what the outlook for inflation could be. Of course, when we did talk about the latest RBA result, which of course was a steady result for April, the Reserve Bank did mention in the commentary that it still thinks or believes that the current interest rate is restrictive. So it is implying there that, it feels the right rate is lower than what the rate is now, which it believes is still restrictive. So that tells you, I guess, if all the factors move according to, the Reserve Bank's wishes, then that they would be prepared to cut interest rates. So that's why we're looking at what those factors are coming through. So the February inflation numbers were lower. Headline inflation fell to 2.4%. Of course, that's right in the middle of the preferred band of 2 to 3%, the RBA's target range. But this is headline inflation. They do prefer to look at the underlying inflation. But headline inflation down 2.4% compared to 2.5%. But underlying inflation, Michael, was also down from 2.8% to 2.7%. One of the factors that led to an improvement was, again, the influence of electricity costs. So that electricity subsidy that the government handed out last year is still having its impact on inflation. The annual fall was 11.5% over January. That was the discount over the year for electricity costs. That actually improved to a fall of 13.2%, Michael. So that was an improvement. And fuel prices are also improved to a fall of 5.5% from 1.9%. So they were the two main factors that had our inflation rate falling over February. So that's good news, Michael.
Well, that plus the fact that the money market is now factoring in interest rate falls over the year. In fact, all the big banks have come out also and suggested that as well. Now, we know their forecasts have been pretty inaccurate last year, but they're all falling in the same direction, that there should be a rate cut at the May meeting of the RBA that don't meet every month anymore, and also that there could well be another couple of interest rate cuts this year, Andrew.
Well, I'm not sure that would occur given our economy still being strong, and that sort of reflects all the doom and gloom and the scaremongering that was pretty disgraceful, really, last week, Michael. And I really feel for those that listened to that doom and gloom forecasting that did sell their shares because they were caught out maybe with the rebound of the share market. So it just shows you what I guess the analytics, the quality of analytics are in terms of that. Is it more about creating clicks, or is it about rational commentary based on insights? And that's what we're trying to prove or provide here today, Michael, is looking at the data rather than looking at, the opportunity to gather attention through, the doom and gloom, the usual stuff. But as I said, it was those that fell for the scary headlines last week, if they did sell their shares, perhaps would have been a little bit upset to see the share market rebound as strongly as it did, which shows it's just a sentiment thing, and it's just, driven by, the usual attention-seeking clickbait, doom and gloom. The boy cried wolf.
Well, Warren Buffett clearly, famously said, be fearful when others are greedy and be greedy when others are fearful. The problem is that's easy to say when the market's rising and booming. It's actually very difficult to do when everyone around you is selling up their shares, isn't it?
That's right. But I think the important thing is, and that's what we try to do here, is to give an evidence-based insight into market activity.
Yeah.
Because if you follow the evidence, then at least you can say, well, if the evidence changes, then that's the reason. If your commentary is not accurate, but a lot of the motivation for these headlines has nothing to do with evidence, because there was no evidence other than these predictions, speculation that the American tariff policies would end in some sort of an economic cataclysm, which was just speculation. And as we've seen, these things can change, and quickly, given the nature of the US government. And, if you listen to this sort of stuff, then you can get caught out. And we know in terms of bank forecasting, their forecasts change almost weekly. So what's the point of a forecast that gets refreshed all the time? Now, particularly given that the hard data, comes out in a more, sort of timely and regular basis. And that's what we're looking at here. The other factor that the ABS reported was that there was another improvement in rents with the annual rise. And of course, the ABS measures rents, total rents, whereas here we measure, or My Housing Market measures asking rents. So it does take some time for what we see changes in the asking rent market to work their way through into the total rental market, because of course, people have longer term commitments to rentals, such as leases. So it takes some time for market changes to work their way through into changes in leases. And we certainly have seen an improvement in rents over the past year, and that's being shown in terms of easing rental growth. That's been shown in the ABS data. So they were the factors that kept the inflation rate moving downwards over February for both underlying inflation and headline inflation. And we can see that trend is now consolidating for underlying inflation in the midpoint of the preferred target band for the RBA. It's interesting, we mentioned fuel is an important part of what drives inflation. The falling of the fuel price through the peak of COVID has been has created a major improvement in inflation. And we can see that when we compare inflation with the price of oil. And we can also predict forward what the price of oil is doing, because we can see that now and how it will work, what the price of oil is now and how that will work into the March inflation rate. So again, some good news based on evidence, Michael, for looking at lower interest rates, and that's that the price of oil over March was actually 15.5% lower than where it was a year ago. So we can factor another improvement in the price of oil impacting the inflation rate over March. Again, that's giving us at least some confidence that perhaps the Reserve Bank will think of that cut to interest rates in the May meeting. Other factors, and we can see the latest oil price has been influenced by what's been happening in the US in regard to the US government's tariff policy, and the price of oil is hovering around $60 US, which is the lowest we've seen for some time, Michael. So even beyond the March data, when we're looking into April, there may be some better signs ahead again for inflation. And this is all positive news in terms of the prospect for lower interest rates.
Sure. Having said that, I was thinking of your charts about the lowering price of oil, and the weekend when I filled up my car, and I haven't paid as much per litre for a long time. I guess it's maybe the school holidays and the Easter holidays doing it rather than the real price.
Yeah, look, I went through the same internal conversation, Michael, because I paid over $2 a litre.
Yes.
Well, this is a little strange. Here I am promoting to my audiences that we're seeing the lowest national price of oil for quite some time, and yet here I am paying $2 a litre plus at the Bowsers. So I think there's some questions there, and I think you're 100% right. It is school holidays and then Easter. Perhaps we should have a little bit more strict control over that sort of gouging, but it is what it is.
So, on balance, there's lots of factors that are suggesting inflation is heading in the direction the Reserve Bank wants, going to make it easier for them to make the decision in May to lower interest rates. What's going to happen to future interest rate cuts? Gee, there's too many factors to take into account just yet, aren't there?
Michael, you're just interrupting quickly that, the Reserve Bank is not going to be cutting interest rates willy-nilly, given how strong our economy is, particularly our labour market is. So we've got the latest labour market data coming out this week. So that'll be interesting to see if there's any deterioration. And that would be what the Reserve Bank would need for a longer term view of lower interest rates, because it wouldn't want to be fueling excess demand with lower interest rates in what is already a very strong labour market without, because that would be, danger signals for inflation. So that's another factor that will be looked at closely in terms of interest rate cuts down the track. But we had some other factors as well, just quickly, in terms of the outlook for inflation. House building costs are an important driver of inflation. We've seen some moderation in that. The latest by Housing Market National House Building Costs Index showing a little bit of a rise over February and a little bit of rise over the year. So we need to keep an eye on that. And we're also seeing a little bit of a revival in the annual growth of asking rents, the quarterly annual growth of asking rents as its index, and that's up by 4.2% at the moment, which isn't too far away from what the ABS has stated in its latest inflation data. So look, all in all, the trends are there that you would say a positive for lower interest rates, but we've got another month of data to come.
I just wanted to remind you that this is not specific investment advice because we don't know your personal circumstances, but we're more than happy to have a chat to help you take advantage of the opportunities the current property markets are offering. So why not have an obligation-free chat with one of the wealth strategists at Metropole to discuss your goals, your options, and what you could do. We're much more than just another buyer's agent. We help you safely create intergenerational wealth through strategic property and wealth advice. Remember, property investment's a process, not an event, so you can't just go out and buy any property and hope to be successful. In fact, now more than ever, getting the right advice is critical. So if you're looking to invest in property or buy a home, go to metropole.com.au and organise a time for an obligation-free chat. You're going to find that at Metropole we're big enough to tip the scales in your favour, but still small enough to care. And since we don't have any properties to sell, our advice is independent and unbiased. April's going to be an interesting month for auctions. We discuss auctions every week here because they give us a good indication of how the market's feeling. It's a good in-time indication. But with Easter, there's going to be a break. Then there's the holidays and the federal election coming up. So a lot of people brought forward their auctions to a super Saturday of auctions. That brought more choice for buyers. What happened?
Well, it was a reasonable result, Michael. Not surprising. In clearance rates, auction clearance rates eased a little bit under the weight of that, the typical surge in Super Saturday auctions that we have. Of course, sellers and agents tend to bring forward or avoid the clash with the Easter break. So it's one of the biggest auction days of the year. And clearance rates were generally lower in most capitals, but we certainly had some big numbers of auctions and no surprise there. But you're right, it'll be quieter now over the rest of the month. We have the Easter holidays coming up, of course. Then there's a short break until the Easter holiday, the Anzac Day holiday. And then, of course, Michael, we have the federal election. So lots of reasons why we won't see as many properties going under the hammer. And that was made up for big results there or high numbers last weekend over Super Saturday. So just a quick look at the results. 1,185 auctions in Sydney. Sydney's auction clearance rate, a little bit lower, but similar to where it's been tracking, just under 70% for the first time in a while, but marginally under 69.6%. And of course, the same weekend last year was not the pre-Easter Super Saturday, so auction numbers were lower. But the clearance rate, again, in Sydney was similar. Melbourne, lower, same sort of result in Melbourne, lots of more auctions, significant increase in auctions compared to the previous week. And the clearance rate down a little bit by around about 2%, but still tracking higher the Melbourne auction market than the same time last year. And that's been a trend for Melbourne and Sydney this year, higher clearance rates compared to the same time last year and also compared to the end of last year as well. Brisbane a little higher, auction numbers down in Brisbane, but the clearance rate was higher. Adelaide clearance rate lower, 61.1%, and also Canberra lower at 50.9%. So we will have that pause over the next few weekends, Michael, but it'll still be some insights there in terms of the market. And the trends are, as I said, for Sydney and Melbourne, are clearly tracking higher than where they did at the end of the year and also similar to where they were at the same time last year. Melbourne's trend really is outstanding. You know, not a lot higher than where it was, but the trend is certainly more positive. And this gives us some confidence that the Melbourne market might start to pick up given the last couple of years of subdued activity. The Brisbane, very similar, around the 40% mark so far this year, below where it was during the boom time of a year ago. Adelaide certainly moved down a gear, not tracking as strongly as it did a year ago, which was when they were reporting record auction clearance rates, but still good results there for sellers at, reasonable results for sellers at just under 70%. And the Canberra market, again, moving in the mid-50s, really not showing any signs of a breakout in that Canberra market, which has certainly moved away from Sydney over the last 2 years in terms of activity. If you're looking for the latest weekend auction results, the snapshots released on my LinkedIn site, Doc Andrew Wilson at LinkedIn, around about 6 o'clock on Saturdays, and Michael publishes the full national report on his sites on Sundays, and that includes the regional breakdowns for Melbourne and Sydney and the top 10 sales over the week under the hammer. So we embrace the forthcoming Easter break, Michael. But interesting news in terms of the labour market, though. I'm looking forward to seeing because we've seen a few early signs in terms of weakening there. And that will really get dogs running in terms of the prospect for lower interest rates if we do see a continuing easing.
Well, there's going to be lots of news over the next couple of weeks, locally and internationally. So we'll be back each week to discuss those, even if there won't be many auction results to discuss next week. Look forward to catching up next week, Andrew.
Thanks, Michael.